With the world consistently having economic and financial crises, each and every nation has emerged to come out with extraordinary debt levels. Whether that is a developed or developing nation, not a single country has been excluded from such terror that we've experienced over the past few years. That is, however, until Indonesia came to the scene. This archipelago nation that resides in Southeast Asia has surprisingly one of the lowest levels of debt in the entire world. According to the Fiscal Policy Office of Indonesia, the nation just has a considerable debt of only approximately 415 billion US dollars. Although that figure is seemingly big, especially as it is a figure that outsizes some of our nation's gross domestic product, is in fact for Indonesia extraordinarily small. How could we say this? Well, it is because of the fact that to truly measure how impactful a nation's debt is, we must take a look at how relative their debt is to Indonesia's actual gross domestic product, which if we just round it up would be around a debt to GDP ratio of around 40%. This then as a figure is, as every economist knows, pretty small, especially the fact that we have consistently experienced tremendous external influence led by global shortages, food pricing increases, and so on. Furthermore, to truly elaborate on how small this is, Indonesia's debt to GDP ratio is astoundingly amongst the lowest in the group of 20, or G20 for short, an intergovernmental forum that comprises 20 of the world's largest economies. Their low debt is also accounted for throughout the developing nations globally. They have in fact some of the lowest compared to both the developed nations and developing nations. One may quickly ask, how could this be? How could Indonesia's debt be so small? I mean, we've seen a huge crisis over the years, and in fact there have been criticism and controversies among government bodies about its risky policies as of late. Even the very head of the government has imposed mega infrastructure initiatives here and there, carving out bold plans that cost up to billions of dollars. It is famously noted that across the entire country, Indonesia has in recent years geared up its infrastructure spending, ending in 2021 at about $27.8 billion worth of it. A sheer scale, but not even as much as its initial bold infrastructure move, to which it indicated that it had announced over $400 billion worth of projects from 2020 to 2024. And yet, as these have all played out, the country of Indonesia has consistently paved against this rising trend of debt levels around the world. Well, to answer this question on how Indonesia manages and can keep its debt to lower levels, we must first look at how the nation has dealt with debt over the decades it has been operating in. Back in 1966, Indonesia's debt levels were actually extraordinary. It was unlike today, which it manages so greatly. Back then, it was on the verge of collapse. The country, which only had a gross domestic product of about $5.5 billion, had in fact amassed an external debt of almost $2.7 billion, approximately around 50%. Although it was still fairly a management sum, if the government did partake in a proper restructuring of its own. But the issue here is that Indonesia was combating a serious economic crisis at the same time. Inflation had hit over 630% in just 1 year in 1966, making the average household need to basically spend 6 times more than it had done the previous year. This then means that if it does not address economic issues, then it is more than likely that we will see a further debt burden to the entire country. This issue of overcomplex debt levels was thankful, on the other hand, fixed. Driven by the huge international aid that had happened, led by the implementation of the Intergovernmental Group of Indonesia, which saw donations that amounted to over $111 billion from 1966 to 2003. These donations, and the rising economy of Indonesia, have helped push out its debt, and by 1996, a 30-year time frame from when it had a huge and burdening debt, its debt to GDP ratio had gone significantly down to only 23.9%. A huge fix, especially since Indonesia now has over $227 billion of GDP. Well, that is until another crisis hit. The Asian financial crisis a year later struck the entire world. Indonesia was amongst the worst places to be in during that time. Its GDP had gone down from $227 billion to a seemingly low of about $95 billion, a more than 50% decrease in just 1 year. Furthermore, this had pushed its debt to GDP to rise extremely high, going to about 72.4%, making Southeast Asia's largest country fall. This story is more than likely why we think the government has shifted its ways. Over the coming decades, its debt to GDP has fallen significantly, whereas it would hit a low of about 22.9% by 2011 and an average of 20 to 30%, only to be changed a bit further as the rising economic uncertainty happened in the last 2 years. This is presumably why Indonesia's debt to GDP levels has not truly seen a huge increase over the last 2 decades, as it might have been an indicator that they do not want to put the economy of the nation at risk again. But that is in fact only one argument of the story, as Indonesia's debt to GDP levels are fairly low, might also be because of several more factors. One more significant factor we have identified is that Indonesia's economy has rapidly grown in the last 20 years. This might have indicated that because of such rising economic growth, which as we saw in the year 2000, started with a GDP of only $165 billion to over $1 trillion by 2020. This 20-year increase alone was so significant that it had made Indonesia earn the title as one of the fastest growing economies in the 21st century. With such an increase in GDP, the GDP had likely outgrown the debt by several levels, and it had presumably also outpaced the amount of spending the government was capable of doing so. Spending is another aspect of this entire low debt level. It is because since the economy has been growing quickly, spending could not keep up. Why did this happen? Well, presumably because as we've also known during the past 20 years or so, government policies which relate to overall spending on infrastructure, military, education, healthcare, and so on were difficult to do. This is because Indonesia is an archipelago nation, meaning it is a country made up of several, in fact thousands of islands. With such complex geography, the ability to spend and cater to every island is going to be difficult. Hence why we also think that most of this spending has always been seen within the island of Java. This is also presumably why the current president of Indonesia, known as Joko Widodo, has been aggressively pushing out infrastructure spending across the nation. Because it can afford such debt, and in fact it should do more than what it currently has. These have all likewise played out as to how Indonesia has successfully managed its debt levels, and thankfully was in the right position when the economic crisis hit in the last 2 years. In fact, how it's going to go back to its previous average of around 30 to 20%, however, is another thing. The head of the Fiscal Policy Office of Indonesia, Febrio Kakarubi, has said that Indonesia's fiscal budget is very controlled, which may indicate that there is no rush to lower such debt after all. It is also sure to our interest that we will likewise see Indonesia's economy once again outgrow its debt easily. After all, the Asian Development Bank has projected that the nation will grow over 5% in 2022 and another 5.2% by 2023. Which implies that this trillion-dollar economy will more than likely easily curb out its debt fears amongst the masses. But likely we can also not predict the very certainty of the future, as we've always seen from time and time again that nothing is certain. Just like in the 1997 Asian financial crisis, when Indonesia had seemingly low debt levels, yet in just 1 year, everything had collapsed. So knowing that, what do you think about Indonesia's debt management? Let us know down below. Thanks for watching.